But I think, hopefully, if I'm right, a few years from now, we'll realize that this is only like this at the moment. And even though the chart is like a hockey stick, I think we will have a small part of a much bigger pie some years from now.
Capital efficiency is going to be key, isn't it? Kind of as we move forwards as well. More so than ever, given everything that's happening in the kind of CeFi space and the nervousness of exposure to various different counterparties. I guess you can argue that in the crypto space, we've got DeFi, which is completely over collateralized to some level, shape or form, 100%, 110%. There's a few DeFi platforms that are coming in now that are arguably under collateralized, but they are certainly rare and far and few between. But most of the centralized exchanges where you're actually kind of trading, a lot of the problems are that you've got to send your assets to the exchange to trade. And then if you want to get them from one exchange to another exchange to take advantage of arbitrage opportunities, you've either got to trade on credit, so you've got to have that credit extended to you, or you've got to get your assets to that exchange to take advantage of arbitrage opportunity, by which time the opportunity could be completely gone. I mean, these chains, these settlement times and these chains and these block times that are, we're using to demonstrate certainty that we've actually got these assets. Bitcoin runs at a block time of 10 minutes per block. So if you're running 3 block confirmations, that's half an hour. But even that half an hour is much better than the T+2 settlement position that we've got in traditional finance. I mean, I can see a world where that's getting quicker and smoother, but how do you manage with your positions if somebody's, I can imagine the markets move really, really hard, really fast, and you could end up with a position where one of your clients is underwater and they've promised you assets, but are you extending credit to people, or are you kind of looking at other different ways of kind of helping people manage their collateral and credit position?
Clean answer. So we have 2 types of margining. One is standard margining and the other one is portfolio margining. Standard margining simply means we look at positions from a leg-by-leg basis. So market goes against you, your, let's say, short puts, we buy back the puts in the market. So it's simply your position is via the order books moved to someone else. We don't have a backstop liquidity provider program. It's simply the algo, and the algo caps position sizes to a certain extent as well, simply because order books can only absorb so much. But then we liquidate your position by, in my example, buying back the options in the market. Then we have portfolio margining, and portfolio margining is a little bit more advanced, but that's also for the people with a bigger portfolio. So people that are having a lot of different options, long, shorts, puts, calls, futures, perps, different expiries, etc. And this basket of positions, if that position, if maintenance margin is not sufficient, or equity is not sufficient to cover maintenance margin, in that case, instead of just us selling, let's say, a single position out of this basket, but possibly ruining the entire hedge, we would start delta hedging. And delta hedging means we buy or sell futures in your account, which was not initiated by you, but make sure that your position is managed from a delta perspective. So it should be risk neutral. Perhaps there's some, let's say, gamma risks left, and at some point there's still, let's say, equity leakage in the account. It still goes against you because of market development. If equity is not sufficient or no longer positive, we would take the full position and we would manually liquidate it, which could be the algo trading or a person from the risk team. And if the product expires tomorrow, we would keep it and hedge it. But at some point, if the client would not have sufficient asset, we have to liquidate. If that goes fast, by delta hedging, you can slow it down, because if the market moves fast, we can instantaneously delta hedge. It's automatic. So you slow down the problem. But at some point, if there's no assets, there's no assets. Do we make exceptions? Yes, we have. We will be very rarely doing so in the future, or perhaps not anymore. One of our shareholders had an exception, which was 3 arrows. which resulted in us having a claim against them now as well. So we've been friendly towards one and giving them credit, which was too friendly in the end. So we end up with a claim against them.
Yeah, it's a common story in the market, isn't it?
Yeah. And I think there's no good explanation for doing so. We've been too friendly for a shareholder. We won't do this again. It's a painful lesson learned. In the end, it's possible in CeFi, which makes it a, let's say, personal relationship thing, which might be good and not good, depending on your side of the equation, of course. For us, we will be more strict, but I think the fact that it's people and people willing to risk something for clients or willing to whatever makes it a relationship thing, which is different than DeFi. DeFi is a programmed solution, and in DeFi it's just totally impossible. Is this good or bad? Sometimes, of course, it's good because it would protect you from problems. On the other hand, it would also prevent you from solving these problems. So it's difficult to say on a net basis what is better. What is clear is that DeFi can't provide the margin efficiency that CeFi can. And for options, that's tricky. If you want a complex portfolio, protecting you or offering you the benefit of certain positions, you can't do that if it's fully funded. It's simply too capital inefficient. So you will see directional exposures, a hedge, most often simply out of the money options writing. So a subset of the market is suitable for DeFi, I think, but not portfolio margining, which is, I think, one of the key drivers for our success in this space, is our more advanced portfolio margining solution. We're launching combos this month, so strategy orders like call spreads, put spreads, etc., in one single trade. Very, and stuff like that is not straightforward in DeFi, and the speed of the protocol, I think, will pose issues as well. So I think protocols are getting faster and faster, but I'm not sure they're fast enough to handle like a proper options book. I think an option trader expects an options chain, as in a lengthy screen of prices and everything's priced and traded real time, instead of a RFQ model for sync positions. So I think DeFi is amazing. I'm not criticizing DeFi. It's like a very powerful solution, but I'm just not certain it's suitable for every solution. And I think options positions is perhaps I'm missing something, or it hasn't been developed yet. But like a proper challenger for Deribit in the DeFi space is difficult because of this. And competition is good, but it's not a like-for-like model at the moment.
We're just not as mature. I mean, the Deribit model takes the best of capital markets and applies the best of crypto in terms of the 24/7 position and all the ways of kind of managing the various position. I remember in the early days when it was purely native BTC, and it's like, okay, this is actually really exciting, kind of seeing this there. And then obviously you've taken us down the journey as how things have progressed and evolved. But it's a needed tool, in my opinion, in terms of the ecosystem. It's something that everybody that's sophisticated in the marketplace talks about. And I think if there was a room full of people sitting behind me, they'd all give you kind of virtual high fives right now, because I don't think the market would operate without you, to be honest. If I'm being brutally honest, it's amazing that you're here.
That's a lot of credits. Appreciate it, but it is. I think if you look at any traditional market, there's a ratio, and you have spot, you have futures, and you have options. And options is always a number of times bigger than the other two. Not because of speculation, because in a lot of markets, options are not used by retail. It's if you look at stocks, Eurostoxx 50 in Germany, it's not a retail product. But still, if you look at the volumes traded and the size, it's simply the output of a very efficient market. And that's an institutionally driven market. So it's not a gambling product, which some people think it is. It's not. It's the opposite. It's a hedging product. It's an efficiency product. It's a capital efficiency product, and that's, I think, key. And that's what drives the expected growth. I'm fairly certain or convinced that a year from now we will have way more clients. The volumes will be higher, the open interest will be higher, as part of the maturity of the overall market, and most likely we have a lower market share, and that's actually not bad. It's a good thing. There will be more options traded globally by a few,
but a much bigger market, right?
Yeah. And then
yeah,
we welcome competition. If people compete with bringing new stuff or new clients or new volume or new ideas or new ways of designing a UI, it's amazing. If it's only built to take our market share, you can wonder why is there really a need for this solution. But if it brings something new, it's amazing, because it might be challenging, but it actually helps us. It helps our market makers. They can become more profitable. For them, it's also tricky. It's not a massive market yet, even though all of us in the crypto space think it's already big, but it's not that big compared to the traditional world. It's small, it's risky, it's volatile, so it's not as profitable as everyone always thinks. Of course, some people are better at it than others, but still, there needs to be a lot of growth to make it worth everyone's while, and that also requires more mature company setups, more regulation in place, everything, and it becomes, of course, the operation will become expensive or more expensive by doing so. So you need a bigger scale, which will undoubtedly happen, because I do think, despite the fact that Bitcoin might be down to 1/3 of its peak, the adoption, the number of people, if you forget about wallet addresses, but if you simply look at the number of people in everyone's space on LinkedIn, etc., the number of people, the number of companies that are starting to do stuff. We're still early days, even though there's lots of big firms already there. It's still, I think, nascent. And the option space, we are very proud of what we achieved. But I think, hopefully, if I'm right, a few years from now, we'll realize that this is only like this at the moment. And even though the chart is like a hockey stick, I think we will have a small part of a much bigger pie some years from now. And I think it's not only my belief, that's why a lot of firms are joining, because they think this is just starting.
Hey there, revolutionaries. Thanks for tuning in. For more content like this, head over to realvision.com/crypto and get unfiltered access to the most brilliant minds in finance and crypto. Join our community of lifelong learners for exclusive access, unparalleled education, and unbiased insights.